Alrighty, we are officially recording. Welcome to tonight's options class. It is the 19th of August. I do believe this is the sixth class. I'm not sure, either the sixth or seventh. I do believe it's the sixth class, and things are going great. Keep improving and improving. Our trades are going, I guess, perfect. Um, and I'm getting lots of good feedback. So if you guys are interested in any other things, go ahead and email me with any of your comments, any requests, anything you guys think would be beneficial to yourself and the group, and we will do what we can to make it happen. So I was just saying before we start recording, we're going to go over the markets, and then we're going to go over the positions that we have closed out this week and last week, and then we are going to dive into our trades. We're going to take two trades or put two trades on tonight. One of them is a very advanced strategy, and we haven't really dove into anything advanced, such as what we're going to do tonight. And so it's going to be a little bit new. We're going to place the trade tonight. The advanced one, both trades we're going to place tonight. They're not going to be directional plays. One of them will be. One will be a very neutral play. And they're both placed to where we could spin off and possibly, even if they don't work in our way, they don't work out the way that we had envisioned, we're going to go ahead and manage them into the future. So something we haven't been able to do because, as you guys know, most of you have been with me pretty much the length of this program. Some of you maybe half the time. But we've had 5 weeks of trading here, 5 trades put on, 5 winners, and we're out of the market. So we're looking to get back in the market. We're not going to place one trade tonight. We're going to place 2. But we have had a very good run here, and no complaints as far as I can see. And people are starting to pick up here, starting to make some profits, and understand what we're doing here. But we're going to branch out a little bit tonight and get a little bit more advanced. And I'll just go ahead and tell you up front, we're going to place an iron condor. That is going to be we're going to sell a call spread, and we're going to sell a put spread. We're going to set up an iron condor tonight. Right out of the gate, we're not going to leg into an iron condor. We're going to sell an iron condor right out of the gate tonight. And then we're also going to do a bull call spread, which is also different than what we have been venturing towards over the last, I guess, 5 weeks. So we've been selling a lot of premium. We're going to sell some premium on an iron condor, but we're going to buy a bull call spread. So changing it up a little bit. We're hoping we can work with these positions and we can manage them over time. But nonetheless, we're still going to put on very, very high percentage opportunities, and we're going to expand our educational repertoire. So any questions before we really dive into this, guys? Before I start my little rant here for probably what's going to go on for like 45 minutes? That's okay with you? Good deal. Good deal. Anything, guys? I will cover it before we get started. If not, I'm going to get going here. If I write something down, it might be, and you find it beneficial, it might be nice to take some notes tonight. We're not going to do anything too crazy as far as rules. We're just going to put on some stuff. We're going to talk about a few things, and then the iron condor. Not just putting it on is going to be educational for some of you, but managing it over time is going to be educational for some of you. So that's what I'm looking for. Looking for us to take that next step and become even better options trader, better than we already are. So, all right, let's go ahead and get started here. This is the SPY. Let's just look at the S&P 500 here. We've had a very nice run here in the stock indexes. They got their pullback. We were talking about this last week. If you go back 1 week ago and look at our options class, we measured each one of these moves. Historically measured each one of these moves, these main pullbacks that we get, and they're all right around that 7 to 9 points. 7 to 9 points. And this was no different. This came last week. We were sitting right here as we were doing our options class, and we said, well, let's look for a long opportunity because the markets are likely to get a bounce here. They historically, this is only a year's time. Even further back, we've been in this uptrend. This has pretty much been the average, a 7 to 9 point pullback, and this was no different. It was a 7 to 9 pullback. Not to mention it was testing resistance at the time. It was just a very, very, very technical market. So we were looking for a bullish opportunity. Sure enough, market's got a bounce, and that's where we're at today. We're up here testing a high. So I got to go ahead and say that we are bullish on the market. Worst case scenario, we're bullish to neutral because maybe we'll hit these previous highs here and maybe it'll pull back a little bit. But nonetheless, the overall momentum of the market, the whole overall strength of the market is without a doubt to the upside. I think you guys will agree, right? If you think that, hey, well, it's overextended, we're double topping. Well, we thought the same thing back here, back here, back here, back here. You know, we can go on for days here. And it's the same story that we hear all the time. But nonetheless, we're in a bull market, and that's how I'm going to trade it until it fails. So I think we're bullish. So we are going to put on a long position here, but it's going to be a debit spread. And then the other is going to be a neutral market, and that's going to come in the oil and gas ETF. Okay. Let's quickly go over some of the positions we have closed out of, guys. If we go over here and we click and go to our options program page, let's go over some of this stuff we've covered. You see right here has been our positions. I've had lots of feedback. You guys are getting the same type of fills as me, so no need for me to change too much. I have not placed any of these orders in the middle of the day. This has all been done post-market, and every single time I've ever done anything, I've sent out the email to everybody. So this has been very, very well followed based on what I've gotten from the group. So as you see here, we're closed out of all 5 positions here. Down here, our most recent, I went ahead and wrote on the Capital One. I wrote, I did not get filled at 53 cents. I'm going to shoot for 45 cents tomorrow. And then the next I wrote, no fill, not going to chase this, waiting for next week's trade. So I went step by step, and we walked through this, didn't get a fill. This was a no fill here. First no fill of the program. Going to have more, but hopefully we don't get too many. Up here, love. We are out of this position. We went ahead and we collected 22 cents. We bought it back for 10 cents for a nice 12-cent profit. A lot of you paying 3 cents of commissions probably on this position. So worst case scenario, you're looking at 9 cents at least of profit depending on what you got there. Up here, this is what I really wanted to dive into. We're going to go to the charts and look at some of this stuff, but I wanted to touch base here first, and this will help explain how this process works. We have the position. This is the initial night. We put on the position. We bought Microsoft for $1.44. Okay, we bought it for $1.44. And then you see here we have another line. It says placing a good GTC stop order for 44 cents because what happened, it pulled back, we bought long, and it sat here. And if it was to pull back, it's going to get stopped. We found some support back in here. We put a stop order down here, and that's what we did. So we did that. Then we went in, we played a GCC to sell our 43 calls for $2. We started to get that market to pop. We knew once it popped pretty quick. So we had a level that we were looking for, and then we said, let's go ahead and sell it once it gets up here, and we can sell it for $2. And then I wrote, this should fill as the market prices approaches $45. This was very close. It was 45 and some change that actually hit the $2 mark. So I put that in there just to let you guys know what a probable number should be for us to get that $2 fill. And then today I put in filled at $2 for 66 cents profit, 45% return. We filled the day for $2. $2 minus $1.44, 66 cents. profit. Traded 1 contract, you made $66. Traded 10 contracts, made a little more. So that was definitely a different situation there. That was a straight long call. So that was a situation where we needed the market to move, not like these credit spreads where the market can kind of sit there and dance around and not do much, and we're still making money on time decay. This here, we were paying for this market. It was costing us money for this thing to sit there and trade sideways day in and day out. So we needed this sucker to go ahead and move, in which we knew Microsoft, once it starts to move, it really can move pretty well. So let's go ahead and now that we went over what the stuff is that, how to follow that page, let's look at some of these markets. Let's look at what we've done here. Halliburton had a great trade on here. Halliburton, we had a really nice trade back here, and we went ahead and we had a very, very, very successful trade here. And let's go over it. Right here would be that trade. This is Halliburton. We took a long play right here as this thing was pushed into the upside. Had a nice play. We went ahead and sold. We sold some premium because A, we had high implied volatility, and we were bullish on the market. We had a really, really nice spread down here. Any type of pop-up, sure enough, looky here. Premium sold off, got cheaper. We sold it back. Nice profit there in Halliburton. Great trade. Go to the next one, INFA. I had a position on here to go ahead and short this dude. We went ahead and shorted this, and we had a nice pop to the downside here, but we shorted way back in here. We let it play out for a little while. We were out, and then it went ahead and we had earnings and it popped down, but nonetheless, we had a short position here on the earning. We actually did a bear call spread. So that was our first bear call spread. First one was a bear put spread. This here was a bear call spread. And then over here on BlackBerry, I'm just running through them real fast, man, and then we'll move on to our positions, our current positions. BlackBerry, here's a perfect example, guys, of why we love credit spreads. This is why we love credit spreads. Here we actually went short. As this market rolled over, we went short on this day. We put a spread out here. We sold and we collected premium. This thing shot down, missed my fill just barely, and then it started chopping sideways. Look how long this thing chopped sideways. It's chopped sideways for over 2 weeks, basically. And guess what? As long as that chopped sideways, guess what happened? We collected premium. We sold it for 22, bought it back for 12, and the market has gone nowhere. This is where we got in. This is where the market is. This is where we got out at. Barely made any profit, any move in the market, but yet we still made 45% profit. That's the beauty of credit spreads. Okay. And here is a totally different area of the spectrum. Microsoft, we did a straight call. We bought a straight call right here. We notice Microsoft, whenever it moves really hard, really fast. Really hard, really fast. Really hard, really fast. That's the nature of Microsoft. So what happened? Really hard, really fast. We got a pullback right into our resistance. Got a nice pullback here on our indications. Things were rolling over. What did we do? We said, well, let's buy this. Let's buy a call because it was something different at the time. And what did it do? It went sideways for about a week. Every single one of these days that went sideways, we had to pay premium. We had to pay time decay. And sure enough, then it started to pop. We weren't worried, but then it started to pop, and we ended up getting our profit. You see the $45 level that I went ahead and I put that tag out. I said if we hit 45, we should be able to get filled for our $2 profit, or sell it at $2, and that's pretty well when it hit it. So, and then finally the LUV. We love this position. This is self-explanatory, guys. Oil's selling off. Look for them airlines to pop. Sure enough, we had a nice little position here we put on here. It didn't take long. This only took less than a week to go ahead and work out. So put on a nice spread down here. Took less than a week. Nice little profit. Ended up making 50%, 55% on Southwest. So those are our 5 positions, guys. I don't think there's any questions about them. They're pretty self-explanatory. We went over them in detail, but I did want to run through them just to touch base because we don't have any positions to edit tonight. Usually we go back and we review and we go through our positions that we still have on, but we have been filled for a profit on every single one of our positions. So I'm just doing a review rather than what we would be doing with managing the position. So that's why we just did that. Now we can go ahead and we can start to slowly start talking about what we're going to be doing tonight. Any questions about these positions? Anything before I move on any further, guys? I don't want to rant too much without waiting for some comments or some questions. Does anybody have any questions about any of the positions that we've traded? About any of the price levels we've looked at, any of the orders or types of strategies we've used? Any questions at all, guys? My most would be a credit spread. I am much more comfortable using a high percentage credit spread than any other type of trade. No doubt about it, hands down. Yep. He asked, "Is there a favorite strategy?" And I do have a favorite strategy. That goes without saying. I enjoy doing. It doesn't matter if it's selling puts or selling calls. It doesn't matter. I like to collect premium. Tonight, let's look at the volatility index. If we look at the VIX, now would you guys say the VIX is low, high, or somewhat in the mid? Would you guys say the VIX is low, high, or somewhat in the mid for you? Let's go back a little bit longer. What do you guys think? Where would you say the volatility is nowadays? I agree. It's a unanimous. We know everybody knows it's low. But you see where it's at? So, now do you see why I'm looking a little bit more at buying tonight? I said I'm going to do a bull call spread, meaning a debit spread. So I am hoping for the volatility to get a bounce throughout this trade. Not just the volatility, but also the volatility on the instrument that we're trading. The instrument we're trading is going to be trading at a 0% IV, meaning we're ready to see that thing bounce. If we can buy it here, we're going to buy it down low. Even if it goes up to 20%, which is still very low, it's still going to be a more expensive premium whenever we go to sell. Okay. All right. So we definitely have low volatility right now. Things are low. Looking for volatility to get a little bit of a bounce here and a little bit of a push back to the upside. So what do you guys want to do first? Do you want to do the bull call spread or do you want to do the iron condor? What do we have? Suggestions. What would you guys rather do? Want to do the more advanced stuff first or second? Definitely second. It's a unanimous vote. That came out pretty fast, guys. So that came out pretty fast. So let's go ahead and look at what I found here for a spread. Now, I said before I hit enter button, I said I'm looking for a position that A, I see could possibly be a nice winner, or B, is something we can manage, we can work with and manage. Here we are. This is Cisco Systems. Cisco Systems. As you see in Cisco here, we are pushing higher, but you see here, are we looking to continue pushing higher? Are we at resistance? What exactly is going on here with Cisco? So I'm going to place a spread down here to where if I get a bounce and we bounce back higher towards the 26s, we're going to be out of the position. But if it pulls back, I want to have the ability to maybe turn this into something else. and be able to manage this position. And if that's the case, we're going to have a nice trade here that we can manage over the course of time, and give ourselves more time to. So sorry about that, guys. Give ourselves some more time to go ahead and see this thing play out. I did earlier. I don't have it on here because it's on another charting package, but we do have somewhat of a bullish channel here. Somewhat of a bullish channel here. So we're kind of riding to the lower third of that channel, meaning we got lots of room up here for it to bounce in order to meet that channel line. So even if it pulls back, we're going to have the ability to go ahead and edit this position down and maybe change our orders a little bit in order to give us some more time to see this thing bounce. Okay, so we're going to go out in time and make sure we have plenty of time for this bull call spread. And we're also going to look in here at a little bit smaller time frame on the yearly. And we're going to see that, hey, we have some pretty clear breakage. We get down below this gap, which has lots and lots of resistance. We have lots and lots of resistance that comes through here. We get down below that, we're going to need to manage and do something with time. But anything above that, I wouldn't mind profiting on. What you guys think? You don't care. You trust me. Okay. Yep, let's just go. So let's look down here, though, guys. What do we have down here? That's the IV. Extremely low IV. Look what this thing does. It drops off, and then it works its way back up. Drops off, and then works its way back up. Drops off, and then works its way back up. What do we want to do? I want to go ahead and buy a bull call spread where my support is this level. So as long as it stays above that level, I'm still going to be good. And if we get a quick pop, we can get out of the position by the time it reaches its previous swing high. Let's go and look at some prices. What would you guys say is going to be our support level? 24? 23.75? Somewhere in there? 24, 23.75, somewhere in there. And we want to have plenty of time on this. Plenty of time. Why? Because we're buying here. We want lots of time. When does time decay the most? The closer we get to expiration. 23.75, I agree. 24, 23.75, okay. Looks like 23.75 you guys like. Let's go over here. I'm going to look for the Septembers. We got 31 days. We got 31 days here. So if we look to buy the 24s, and let's sell the 25s to offset our risk. Let's buy the 24s and we'll sell the 25s. That'll put, yeah, right down here. You just hit confirm and send, and it'll tell you. Yep. If you don't know, just hit confirm and send. But yeah, all you got to do is whenever you buy a debit, you go from your bought strike price, 24, and you add your paid debit, 59 cents. So 24.59, man. That's why we asked. We wanted to know, where is our profitability? How low do we want to go? 24? 23? Where do we want to be? We realize now we want to be a little lower. So let's go out to the 23s. Sell, buy, vertical. What are we going to buy here? For 46 cents, we want to buy the 23 24s. That's going to cost us 88 cents. What do you guys think about that? That's going to put it right around that 23.75, isn't it, guys? 23.88 to be exact. Below the 24s, but above the 23.75. What do you guys think of that? You guys like that better? Okay. I had 3 of you agree that this one is better than the 24s. No problem. Let's look over here. 23, just under the 24. Let's see what the 24 brings in. Got about a 70% probability. The 23, actually the 23 half, is about an 80. So we're looking at about 75% probability of success. That means this position actually expiring profitable. Does that work for you? So going into this trade, before we even put this trade on, we're looking at the probability of success on this position here of 75%. I'm okay with them numbers. What do you guys think? And I bet, given ourselves this much room, we're going to have enough time to go ahead and work out a solution if this thing goes against us. Okay? What do you guys think about this position? Are we at a go? What we have on here is we are buying the 23 calls, and we're selling the 24 calls for protection, and that is going to cost us 88 cents. Now we're going to go ahead and give it a shot, and we're going to go ahead and try to buy it on the mid. We should be able to buy it on the mid price, and we're going to lock it in as a day order. Hit this little lock button to get 88 cents exactly. Hit confirm and send. See, we're looking for, yeah, exactly, man. Yep. So, all right, confirm and send. Good deal. Any questions here, guys? Let me go over and report this. We got to get this thing set up and sent. Let me edit this, and we will get this sent off. You guys like this position? The one thing I want to focus here on is, look over here, guys. What's the current IV? 0. The current IV is sitting at 0. Yes, I agree. No, Bill, because I'm going to manage this position. He asked if the max loss bothers me. No, because I'm not looking to allow that to happen. We are managers of our positions. We don't allow ourselves to get to that point. Like a lot of our spreads, we'll collect 22 cents. So we'll look for a max profit of $200, but a max loss of $800. Does that make sense? Well, to the naked eye, no, that doesn't make much sense. But we're not going to allow it to get to that. We manage our positions, and we're not going to allow something like that to happen to our positions. Okay? We're going to buy. What are we buying, guys? We decide to go with the 23 24s rather than the 24 25. Buy the 23 calls. Sell 24 calls. and that's going to be an 88-cent debit, and that is a day order. You can put it at 88 cents though. No matter what it's showing, whatever you're done. If you're buying the 23 calls and you're selling the 24s, make sure you're on the right month, Henry. Make sure you're on the right month. We're on September. You have 31 days left to expiration. Make sure you're on the right month. Any questions, guys? What we're going to do is we're going to buy the 23 calls and we're going to sell the 24 calls. And we're going to pay 88 cents. That's at the midpoint. We're going to place a day order. Everything we do is a day order. We're not leaving buy orders on it, good to cancel. So day order. And expiration September, 31 days left. Okay? That's Cisco. Okay, guys? Now, we're going to go ahead and let that play out. We'll talk tomorrow, and we'll see if we got filled. I will report that tomorrow as soon as the market opens, or as soon as we get filled, or we don't get filled, or whatever happens, I will report that. And I will let us all know what's going on, whether or not we should do any change or everything's okay. But let me go intraday and show you something to look at. See this sideways action? There's a difference here in whether or not you should look for more or cheaper prices when looking to place orders. Okay? Like I'd say all the time in my post-market videos, let's look to see whether we get a rally into the close or a sell-off into the close. That's going to be the determining factor for a lot of ways that the market opens up. We're very neutral here, so we're very likely to go ahead and see a little minor pullback in the morning, which should allow us to get a little bit of a fill before the market hopefully gets popped to the upside. But it doesn't hurt for you. I'm answering your question, T. It doesn't hurt to go ahead and look at the intraday charts when determining whether you should place your order at the midpoint or maybe put more of a natural order in there, whatever it may be. Just a thought there. Okay, let's move on. We're getting we got a little bit of time left here, and we'll answer questions at the end. Next position I'm going to look at is going to be the oil and gas ETF, XOP. And on this position, guys, I'm going to go ahead and I'm going to trade an iron condor. We're not going to leg into an iron condor here. We're actually going to place an iron condor here. So, with that being said, where do you guys see in support and resistance? The reason I'm going with this is I'm ready to manage a position with you guys. So if it works out, great, all that's great. But if it doesn't work out, we're going to really learn a lot from managing this position into what we're hoping down the road is going to be a profitable strategy or profitable management. But we're going to do an iron condor. We're going to let it play out. We're going to stay here together, and we're going to work this thing out until we can make this thing profitable, unless something happens and, we need to cut the bait. But where do you guys see support and resistance? That's what we're looking for. That's always, always, always our first step. Where do we see this stinking thing staying? Where do we see it going? Why did I choose an iron condor on this position? Well, let me explain, and then you guys can chime in too. We have a high. That high got retested. That became a low. That became another low. And that became another low. So we have a very, very, very precise level here around these 72s to 73s. 72, 73-ish. Right? Then you go up here and you're like, huh, we had a nice push up, pushed higher, and now it's pushed back down, and we had this low and this high that came pretty close to these highs here. We retested here. Boy, is this going to be a head and shoulders? Is this going to be just a bigger pullback before heading higher? What is this going to be? I think a lot of people are looking at these levels thinking, huh, that is interesting. So, where is this level at? Well, it's right about, I would say about them 79s, 78 to 79-ish. So what do we have? We have 72 to 73-ish, and we have 78 to 79-ish. What do you guys think about that? And look what this market is. Stuck right in the middle. If we can get this thing to trade sideways for a week or two, we're going to be able to profit on this time decay. If this thing starts to get a rally, meaning it starts to move, we got lots and lots of time. If we go out the same September contract, we have lots and lots of time to manage our position and do some weird things, like sell some calls if we see this thing pushing up. Or if we see it breaking through our lows, we'll look to sell some puts to get some of that money back in that time. So what I'm going to look to do, guys, is I'm going to look to trap this thing inside this range. I'm going to look to trap it inside these levels, and I'm going to click premium on it. And if it heads higher, I'm going to get rid of my spread, and I'm going to find something up here, some way of selling a call to collect time and get this thing to bounce back down as, mind you, as this is going to collect 100% profitability because we are pushing higher. Counter trend that, if we get this thing to break down, I'm going to cancel out of this for a loss. I'm going to leave this dude on so it can go ahead and collect 100% profitability over time, right, as the market pushes down. And I'm going to go out here and I'm going to find levels to sell puts, to go ahead and sell puts and collect every single little bounce that we get back to the upside so I can get back what I just lost here and collect here so it makes the whole trade a net positive. Now we're getting to a little bit different level in our trading. I don't want to confuse anybody. Some of you in here are doing very, very well, and this isn't going to be any issue for you. But we have not had the position yet in this trading program where we can just manage out of a trade, where something goes wrong and we need to manage our way through the trade. That's what's going to take some of us to the next level. And watching this thing play out and watching how option pricing really plays out over time, this could be a very, very educational position. What are you guys thinking about this? We getting anybody shaking their head no? Do you guys like what we're looking at here? What type of feedback are we going to get on this position, guys? I'm going to have to look at some option pricings with you, but I'm looking somewhere in the range of selling the 72s to 73s, buying the 70s to 71s, and then we're going to look to sell anywhere from the 78 to 79, and we'll probably buy the 80 to 81s to protect it. And this spread is going to put this market in a vice. It's what you call an iron condor. Okay? What do you guys think? If this is new and if this is your first Iron Condor or your first advanced strategy, just do it with a one contract. That way we can work on it, guys. No need to go full boat on it. Just trade one contract. Yes, I agree, guys. Man, lots of you gave nice, good feedback there, saying this is going to be very educational. Yes, it will. Because not only that, if it doesn't work out and we get it to break out one way or another, we're going to keep one of these spreads on. Depending on how much time we have left, if we are profitable and have 10 days left or 15 days left, we're probably going to take profits. But if this thing decides to not trade in this sideways fashion and say in 3 days it just tanks or pushes one way, guess what? We're going to cancel out of one of these dudes and we're going to learn to manage this position into a profitable trade over time. Okay? Anywho, so let's go and see what it looks like. Let's type in XOP and let's see how this dude works. All right, XOP here. So I had some things written down here, but let me rewrite them down. We want to stay. We want to stay above the 72s, and we want to stay below the 79s. Does that sound about right? Above the 72s, below the 79s. Let me go back to the chart so everybody's on board. Kind of want to keep this thing above the 72s and below these 79s. Okay? So let's go back to our trade grid and let's see what we can do here. I'm going 31 days out. And I'm going to look to, what are we going to do? We're going to have to sell some calls and buy some calls and sell some puts and buy some puts. So on the put side, we want to stay above 72. So what's that say? We want to go out to the 72, right click, sell Iron Condor. You can do two verticals or you can just do an Iron Condor. You can do two different positions or you can just go Iron Condor. Now, a lot of times I would recommend you putting in two different vertical trades. So you'll do a basically a bull put spread and a bear call spread. But tonight, we're just going to flat out place an Iron Condor. All right, now this thing, let's see, we got our drop down here. Our goal is to sell the 72 puts. I'm going to look at the pricing if we buy the 70 puts, so $2 wide, giving ourselves a little bit extra. Let's go to $1. And then we want to sell the 79 calls. And we're going to buy the 81 calls. Or actually, let's just do the 80s. Do the dollar wide first. So this is having us sell the 79, buy the 80s, and sell the 72s and buy the 71s for 39 cents. I don't want 39 cents, guys. We're going to manage this thing like a hawk. So I want to go out and get a little bit more. So let me see what we get if we go to the 70s. So we're going to sell the 72 and buy back the 70. That's going to skew it a little bit. That's going to skew this a little bit to the downside. I don't want that. I want to be very neutral on this. So if I want to be very neutral, what I mean by skew, I don't want to get anybody off guard there. I'm doing a $2 wide here and a dollar wide here. That's going to skew the profitability, meaning that the break even comes a little bit further this way. But I don't want to do that. I want to stay very neutral here. So I'm not going to skew it either way. I'm going to go to the 81s and see what we can collect. Should be able to collect 60 cents. I would say a little bit more than 60. Let's see here. 80 to the 81s. 64 cents. Okay, so what we have here is we have a selling of 79 calls buying the 81 calls, and then we're going to sell the 72 puts, and we're going to buy the 70 puts, and this gives us that little extra that we're looking for. Rather than collecting something in the 30 something cent range, we're looking for 64 cents here. A little bit better here, guys. So we can collect a little bit more on this position, meaning that we're going to collect about, on this current position, we're looking at about 64 cents or $64 per contract. $64 per contract maximum profit, with our maximum loss being, can anybody tell me? Can anybody tell me what their max loss is going to be on this? Without clicking confirm and send. Without clicking confirm and send, can anybody tell me what your max loss is? $1.36. Yep, you're right. $1.36. You're exactly right. Pretty easy. But I didn't know if anybody would know it or not. So we got a lot of good traders in here, so I figured somebody would know it. But yeah, you guys got it. There's probably a handful of you that got it figured out. One person, I think you did the math backwards. Yeah, you know you did. You gave me a smiley face. But yeah, you just did it backwards. But anyways, $1.36 is going to be your max loss. So we are looking to manage risk. We don't have too much risk on here, guys. 2 to 1, basically, and just a little bit more. So nothing too crazy. We can deal with that. So what do you guys think about this? If we went ahead and placed this order, we're looking to collect 64 cents per contract. Max possible loss is $1.36. And this is going to give us that opportunity to manage a trade. You like it? I like it too. I just want you guys to like it. Because you guys are the ones that are helping me out here and keeping me on my toes and all that good stuff. So we're doing XOP. It's the oil and gas ETF. We're doing an iron Condor. What we're going to do is we're going to buy the 81 calls. We're going to sell the 79 calls. We are going to buy the 70 puts. Is that what we chose, guys? 70 puts? I'm pretty sure that's what it is. Yeah, pretty sure. 70 puts. And we're going to sell the 72 puts. And we're going to do all of this for a 64-cent credit. And this, just like every other position we place in here, is a day order, always. And we're going to do the expiration is going to be September. This is going to be the best learning curve. You're right, bud. This is going to be a different ball game than what we've been doing in here. We've been doing lots of vertical spreads, and we've been doing so darn well that, and not to toot our own horn, but we've taken quick profits on basically everything we've done, guys. So, I mean, I'm not tooting our own horns, but you can be successful or be proud of how well we've done, because we're 5 for 5 in here with great profitability. So, I mean, you can go ahead and be happy for yourself, but we're looking to put on two positions tonight, guys. A little bit different than we've done in the past. We got a bull call spread here on Cisco. Okay. We got a bull call spread here on Cisco. And we're putting on an iron Condor. Much more advanced strategy here on the oil and gas ETF. XOP. So we want XOP to stay very neutral. Go back and okay, I will absolutely, man. I want you to be right on the same page as me. So, here we'll go back to the chart. Here, let's go back to the chart, and I'll explain. He wants to go over that one more time on what we're going to do and how we're going to manage. So this gives you guys a heads up, so you're not kind of caught off guard if I send you something, an alert, and you're like, what in the world is he doing that for? Okay. We're going to sell the 72s, buy the 70s, break even somewhere in here. We're going to sell the 79s, buy the 81s, break even somewhere in here. So, as long as this instrument stays inside this range for an extended period of time, we're going to collect premium and we're going to profit on this. But if this thing pushes up and it rolls over, we're going to keep the position on. If it comes down and rolls up, we're going to keep the position on. If it comes up and breaks through, right? It breaks through, we need to cancel out of this, accept our loss. I'm going to go further up here, and I'm going to find some type of premium I can collect as this thing comes up and pulls back. So I'll sell something like an 85 call or whatever in the world it is to collect premium. What am I doing that for? Just to collect some quick premium as this market will push up and then roll over eventually. Just collect some premium as what's going on down here. As this thing just continues to rack up the numbers. Up, 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 up. 100% profitability. The higher this thing goes, this thing will collect 100% of its spread. And then to the downside, if this thing starts to sell off, no sense in keeping this because, hey, it's wrong. If it gets down below here and it doesn't get a bounce back up, it continues trading lower. What do? As it's trading lower, it's not bouncing up, it's rolling down. What do? I cancel out of this. I look left, I find some type of support, find something, and I start selling premium. I'll start selling some of these premium levels. That way, if the market comes on down, gets a little bounce, I'll take a little bit of premium. Comes down again, takes a little bounce, I'll collect premium. I'm not looking for a lot, but what am I doing? I'm going to take minor percentages out down here, small percentages out down here, just enough so whenever this thing becomes 100% profitable or expires worthless and I collect 100%, we're now net positive on the overall position. And this minor loss that we took here on half the spread, that gets wiped out by these percentages, and we got 100% on this spread. It's hard to envision now, bud, as I know that you started your option trading as soon as we started this program. So your option days are very limited. But we're going to walk through this, and we're going to do it step by step, and we're going to do all this together. Every single time, I'm not going to be placing some random orders in the middle of the day. Everything I do is going to be in the evening time, so I'm going to be able to place my order, I'm going to be able to adjust my positions, and then I'm going to be able to send out alerts so you can have it placed by the next day. If one leg gets to near 100% profitable, you will keep that one spread on? No, Bill, I'll collect 100% profitability. Bill, and if either one of the legs gets close to 90+%, I will collect that. Any questions, guys? Okay, Tom, I got your message just now. Let me look at that. He's asking me about the love position real fast. There's no more questions here. I'm gonna keep collecting questions, but I want to look at this. Said no is 24s. You mean selling the 20? So you're still in it, Tom. You're still in this love position. But you are probably 90 plus percent profitable, right? I would just let it expire worthless. You are 100% going to be 100% profitable. Just let it expire worthless. How much time's left on it? Still got a lot of time or not? I would, if you think this thing's going to keep heading higher, you are so far in the money here. You could probably let it expire worthless or do what you said. 31 days is a long time, though. Yeah, that's a long time. Um, yeah. Um, what do you got to buy back the 26? Yeah, buy them back. How would you eliminate the one losing leg? You just sell it. There are going to be two different spreads, Bill. Bill asked, how do you eliminate one leg of an iron condor? You're going to have two different spreads, Bill. When the order gets placed and gets filled, you're going to have two different credit spreads. That's pretty much what you're working with. And all you got to do is simply buy back one of the credit spreads. Not a dumb quite, no. So, does that make sense, Bill? You're going to have two different credit spreads, and you just buy one back. So we have what, the 72 70s and we have the 79 81s. These are two different spreads. You can just buy simply. You can simply just buy one back. Yeah, it's literally that easy, Bill. So yeah, yeah, that's my best recommendation, Tom, because there's just too much time left for you. As I would hate to risk all that with that much time left. He's got the love position on, not able to get out in 24s because this ran so much. I got out a long time ago, but right now he's not finding anybody interested in 24s, so it's very difficult for him. You could let it expire worthless, or yeah, get some of your position off, and if it does pull back, you'll at least be able to get rid of it. If it keeps heading higher, it'll be worthless. So you're in a great position. Yeah, you need to take some profits, though, Tom. True that. So great trade. Great trade. All right, guys. Any questions? Very, very awesome night in here. We went to a whole new level, and I can't wait to see if we can manage this position. You're welcome, Tom. I can't wait to see if we can manage this position or if this darn thing just becomes profitable. I mean, obviously, I'm not going to complain if it's profitable, but we are looking to maybe manage some of these trades together and take some of our trading from the basics to the very next level and be able to really dive in and understand option pricing. Understand that, hey, if this didn't work out, well, how in the world can I recover that? How in the world? This is not like day trading the futures. You can manage this because guess what? You can use multiple different price levels and put percentages on your side here. So a lot of advantages to trading these options, and a lot of advantage to understand what the options are going to be priced at, using volatility, using time decay, using all kinds of different stuff, and understanding, how to manage out of a position or how to recover from a position. More importantly, so. All right, guys, are there any more questions here? Any more questions? Let's go back over to XOP because that's where we just put that position on. Not very often, Bill. I have. He's asked if I've ever allowed things to be exercised to get long in an underlying, say as a short put or something. It has happened. Obviously, it's actually happened on accident several times. Um, but very rarely. I'm doing this simply to, the reason I like to trade options is because of leverage and the ability to diversify capital very efficiently. So I'm not actually trading options in order to get long 100 shares of stock or 1,000 shares of stock. So um, that's usually not what I'm looking for. No, I'm trading options, solely so I can have the leverage and have the reduced cost, and I can put on several small positions and be all over the board rather than allocating a whole bunch of capital to one instrument. So I got a little different outlook than that. So I guess my answer is no. I don't ever really want to do that. But yes, it's absolutely happened. All right. 64 cents. So we're looking to collect $64 per contract. $64 per contract. Our our two different break evens is 71.36 on the downside and 79.64 on the upside. So as long as the stock stays between 71.36 and 79.64, we're going to keep on collecting that time decay, keep on collecting that premium, and let this position just do what it's got to do. Yep, you're welcome. You're welcome. Good question, though. Any other questions, though, guys? Sell it, John, or they're going to be asking you for some more money. That basically what you're asking? Yeah, if the account is that close, obviously we're on margin, but they're not going to allow you to have a position that they can't cover with margin. But um, if it ever happens, yeah, you're just going to want to get that money back and take the loss. So sell out the shares and get that money back in your account. Granted, you're going to take a loss, but that way you're out and you can start allocating that capital other places. But yeah, if it's going to eat up all the account, um, absolutely get rid of that stock. Unless you plan on just letting it give you stock and then holding on. Yeah, you'll have it, John. Yeah, oh yeah. So, all right, guys. Any more questions? Any more questions? That's an oil and gas ETF. Oil and gas ETF. Yep, XOP. I'm excited about this, guys. Hopefully, we can get to manage this. Watch this thing go absolutely nowhere. Go sideways for a week and a half. That'd be crazy, wouldn't it? It can do it. Looky over here. It can do it. It moves very little. It moves sideways. It moves sideways a lot. Lots and lots of sideways movements in this instrument. So it's very possible that this thing could move sideways for, another week or two. And if that's the case, well, hell with it. We'll just collect. We'll just take profits. But, all right, guys. Any more questions here? We've gone over our hour. We got long-winded again. We always do. So, thank you very much, guys. I love the nice words. I would be, Bill, but that's just the nature of it. He's asked, would you be happier if the IV was higher? Absolutely. But I'm very happy with the technicals on the position, and I can see that they are rolling down here. We got lots of more room here down to the 2019 level here on the IV, so I'm not too worried about it. As long as that time, all we're worried about right here, mainly the main ingredient of this bill is the technicals and time. We want to see the time pass. We want to see each day get by. Time, 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 time. We just want to keep on seeing these days go by and the market basically go nowhere. So that's more important right now than that volatility. If we go nowhere for a week and we actually get down to like the 19 on the volatility here, we're probably going to be near that profitable stage where we can get profits on it. So something to think about. Any more questions here, guys? Any more questions? All right, you too, Tom. I'll see you bright and early in the morning. Take care of that love position, that Southwest trade, and congrats. That's a nice position. All righty. I will see you guys in the morning, and I'll see some of you next Tuesday night and in the nightly emails. You guys have a good night, and I'll see you when I see you. Bye bye.